Welcome everyone today to the Relab webinar. Our special guest is Jarrod Kerr. He's the Chief Economist at Kiwi Bank. Jarrod's got a wealth of knowledge and experience and is no doubt going to provide us some valuable insights today. So today's discussion, we want to cover three main points around economic trends shaping the housing market, and we're going to delve into topics like interest rates and the last of the record low mortgage rates rolling off. And then we'll take a closer look at market factors impacting supply and demand, and hopefully a little crystal ball gazing into what that could mean for the future. So our goal today is to provide you with valuable insights on the New Zealand economic landscape and the property market. And without further ado, welcome, Jarrod.
Good morning, and thank you for inviting me along today. I love the opportunity to give these sorts of chats. I'm always keen to hear the questions that come through. It gives me a good insight as to what people are thinking and feeling out there. So I'll do my presentation, but at the end, I'm really keen to hear from you and ask as many questions as you like and guide the conversation where you want to go. I'm just going to share my screen. Like all economists, I have thousands of charts and I like to use them.
This is great. We're in property data, so we love it.
Yeah, well, I've got some charts in here that hopefully you haven't seen before. Can you see that?
Yeah, that's come up now perfectly. Yeah.
All right, cool. Okay. So the main message, I think, globally is that, inflation has peaked, which is key. It's been a big driver of central bank activity over the last couple of years. We've had inflation running at very high rates. Central banks are getting on top of it, which is good news, and it's heading in the right direction. There are some frustrations out there, however, that inflation is taking too long to get back to where we want it to be, which is around 2%. And our own central bank just the other day came out and said, we're a little frustrated, we're a little impatient, and we're, very wary about the inflation outlook. So we'll talk a bit about inflation because it is important. And then we'll talk a little bit about what's happening in the economy and how all of that is feeding into the housing market, which I think is turning around. I think the housing market has turned a corner, and I think we'll see a better year next year, and then heading into 2025 and beyond, we'll see a housing market which is making, good but fair gains in terms of price. So being a New Zealand economist, you've got to start overseas. If you want to look at New Zealand, you've got to have a bit of a handle on what's happening around the world, particularly with our trading partners. And we can see in these charts here that we had quite a boost to demand globally after COVID. So central banks and governments poured trillions of dollars into their economies to try and get through COVID, try and help firms deal with the COVID lockdowns, but also, trying to make sure people kept their jobs. And they did a good job. In fact, they overstimulated. They did too much. And then we saw inflation rise. But over the last year, things have cooled. Things have cooled down quite a bit. Our trading partner growth is a lot lower than what it was this time last year, and it looks like we'll see that sort of continuing into next year. For those of you interested in financial markets, most Kiwis have about 98 or 99% of their wealth tied up in housing. But for those of you that like to have a little bit of a punt in equity markets, it's a bit of an awkward time. And the more active investors out there are actually looking to sort of redeploy, get involved in the next sort of 6 months, and I think that's a good idea. If you want to know where equity markets are going, it's important to see growth figures out of the major economies, because when the global economy is performing well and we've got strong growth, you get strong gains in equity markets and most asset markets. Right now, that global growth is quite weak, and equity markets are, I'd say, struggling. The chart on the right there shows, you know, some of the volatility that you can get. We had that COVID meltdown where equities fell quite sharply, and then interest rates were slashed. Central banks poured trillions of dollars at the problem, and the shrewd investors out there got involved. When central banks start supporting like they were, that was a signal to most equity investors to actually get involved. And we saw equity markets from 2020 really take off. Now interest rates have been lifted quite aggressively, and equity markets are struggling. So what, you know, a lot of portfolio managers are looking for now is the next move. So they're waiting for interest rates to fall. And once you see interest rates start falling, you will see equity markets rise. And the same can be said for the housing market. We're kind of waiting, hopefully, you know, expecting rate cuts to come in the sort of second half of next year. That will put a bit of put a bit of gusto, put a bit of petrol in the tank, and we'll see, you know, housing markets as well as equity markets and most asset markets perform quite well, I think, over the second half of next year. So what is our central bank doing? Well, our central bank has taken the cash rate to a very high level. They've lifted interest rates in the economy to a very high level, and the whole point of doing that is to slow growth and slow inflation. They're fighting an inflation beast which has been driven by a few forces. To start with, it was global supply chains seizing up. That's no longer a problem. So the time it takes for a container to arrive in New Zealand and then, you know, go to where we need it is back to normal. The cost of buying that container has gone back to pre-COVID levels. So the inflation that we saw coming out of supply constraints has reversed, which is great. And we're just kind of looking to see what petrol prices are likely to do over the coming year. But, you know, if we were to use our modelling of macroeconomic variables, it suggests that, you know, petrol prices will be lower in a year's time than where they are now. That's important. That's important because global inflation has not only peaked, but it's heading in the right direction, and we think it will continue to head south. So if you think about our trading partners, I've got a chart here showing their inflation rates all heading south and hopefully continuing to head south into next year. That is a great backdrop for us, where, you know, US inflation has dropped from 9 to 3. Inflation in the UK has dropped from 11 to I think about 5 now. Our own inflation has dropped from 7.3 to 5.6, and it's heading south into next year. That's a key development, and what will drive our central bank here is how inflation runs over the next year. And our forecasts are that inflation is going to fall from that 7.3 to 5.6 to about 4.7 by the end of the year, 3% by the middle of next year, and then back towards 2% by the end of next year. That would be a great outcome. If we're right on that, then the central bank will be in a position the end of next year to start easing rates. They've told us they may have to raise the cash rate one more time in the next 3 to 6 months, but the next big move, I think, will be lower for interest rates, you know, over the second half of next year, and that's important for property investors. One of the frustrations has been around the cost of building a home, the cost of developing. and those experience costs are still very high, but they're falling. I was talking to a developer just a couple of weeks ago, turned to me and said, "Do you know the price of steel has actually come off?" I said, "No, I didn't realize that." And he was telling me the price of a lot of materials like jib and all that sort of stuff is not rising like it was. In fact, it's sort of stabilized, and we may actually see some of those prices coming off over the next year. That would be great. We kind of need that. We need the cost of materials to come back, because we need a surge in supply of housing in this country. So that chart's quite important. It does show just how heated the inflation problem was in New Zealand, particularly in housing, and we're hoping that reverses over the coming year. And what's important behind the sort of scenes from a behavioural point of view is our expectations. So we all knew inflation was running at 7. It was then running at 6. It's now running at 5 point something. It'll be at 4 point something. Those big figure changes, those big drops from 7 to 6 to 5 to 4 are quite important, because that's where price setting is set off. People look at the inflation rate. I want more than that in my wage gains. I need to pass on more than that if I'm to maintain profitability in my business. These sorts of decisions are kind of based off inflation expectations, and they are falling, thank goodness. So again, that's a positive, and I think it'll be reinforcing a lower inflation outcome. So what does the Reserve Bank do? Well, we think the Reserve Bank stays on hold, even though they're threatening to hike again. We wouldn't be surprised if they do deliver one more hike over the next 3 to 6 months, but we're of the opinion they don't need to. The next big move, we think, will be down rather than a small up potentially, but the next big move will be a downshift in the cash rate into 2025, and therefore, mortgage rates at some stage next year will start heading south, and we kind of need that to reinforce our housing market. One point that I'd like to make, and I'm sure everyone on this call is well aware, is the big jump in mortgage costs experienced by people in the housing market. It was 2 years ago where interest rates were at record lows, so the lowest we have ever seen in our history, even lower than what we had in the 1950s after a world war. Mortgage rates got down to about 3% in the 50s. Now, the record low was in the low 2s from 2021, and that was extraordinary. And people made decisions on those rates. So people came into the market thinking, okay, well, I can get a 2.1, 2.3% mortgage. I can spend X on a house. So a lot of people made decisions on those rates, and then just a year later, they had doubled. And now, 2 years later, they've tripled. That's massive, and that's a big deal for people who are relatively new to the property market. Those of us that have been around for a while, that was an extreme low, and we sort of realized it was an extreme low, but there are many people out there who are relatively new and sort of thought, well, maybe 2-3% is about normal. On top of that, we had tested people at about 6% or slightly below. So they took out a mortgage, paying 2.3%, for example, but we tested them on 6. So we wanted to make sure that they could pay 6. Well, actually, here we are at 7+. So, those people tested it at lower rates. Not only are they paying more, but their their budgets, their ability to pay is being stretched quite a lot. So we're wary. As a bank, we've fielded a lot of phone calls, as you could imagine, over the last year or so, as people roll off onto these much higher rates. We're not seeing proper stress. We're seeing people, complaining about the rise in interest rates, but we're not seeing defaults, which is the key bit. And we've got a tight labour market, so people have jobs, they have income. It's just how that income is divided up, which is hurting. So that's how I sort of watch this space. As debt servicing increases, the stress on household increases, but when they lose their jobs, that's the bit that we worry about. That's when you see default rates picking up. We're not seeing that. We are forecasting it. So people like me are telling decision makers within Kiwi Bank, there is a good chance we see a little bit of a lift in defaults. So let's put some money aside for it. But we are only seeing, I think, small increases off very low bases. And when you compare that to, say, business lending or agriculture, it's still very, very, very low and strong. One thing I would also like to mention is, that we had this cyclone. It's going to be a massive rebuild effort. The point I want to make here, though, with regards to housing, is that there are going to be more and more homes that will be classified as high risk. That it's happening, already in Hawke's Bay and other areas. But one large insurer in New Zealand came out not that long ago and said there's about 20,000 homes in New Zealand that will be considered high risk. That number's only growing because we're trying to think about sea level rise as one issue, but also flooding in general as another issue. And there are simply areas in New Zealand that are high risk, and that number of homes is growing. So not only do we need to relocate 20,000 plus homes, we need to build a lot more homes in the wake of this. And one thing I want people to be wary of is that not only are the costs of insurance going to go up, that's one thing, but there may be exclusions. So you might find that you have a property which is, low and, may be at risk of flooding or sea level rise. The insurance company may come to you now or in the next year or so and say your premium has tripled. That's one thing. But they might also come to you and say you're now excluded from flood. You now have an exclusion in your insurance policy. We can't insure you for flood. The bank is then going to have to make a decision as to whether we put a mortgage on that property. That's going to be a very awkward discussion for households in these affected areas, and it will be a devaluation event. So any house that can't get a mortgage will be that much harder to sell. So there is a first mover advantage here of getting out of these areas, and it's a very difficult discussion that we're going to have, I think, with our clients over the next 5 years. But it's coming. It's happening now, and I think people on this call need to be wary of it. That's bad news. Where else do I want to go? One of the things that is complicating our outlook is the confidence amongst businesses out there. They're still complaining about high costs, whether it's labour or other costs. They're worried about their profitability. So when you have high costs and reduced profitability, businesses, they tend to get the old tunnel vision happening. They sort of look down and try and put out fires where they can. They're not looking to the future. They're reluctant to invest, and we can see, on this chart here, that business investment, their intentions is actually negative, so they're looking to contract. And we're hearing from many of our business customers that they're actually, not only reducing their investment intentions, but also their hiring intentions, and looking at reducing staff levels. So that to me points to a much weaker growth outcome. RBNZ wants this, but it's still not good from an economy's point of view, when you're the backbone of your economy, the SME businesses are worried, and they are worried. They're a little bit more upbeat after the election, but they're still worried. And so are consumers. When you ask households, how are you going? They're turning around and saying, look, there's a cost of living crisis. I'm spending a lot more on my essentials. I'm getting less for my money. I'm having to divert money away from luxury goods or discretionary items, because I'm spending so much on my essentials. On top of that, I've just been slapped with a massive increase in my mortgage bill. So there's a double whammy there. And on top of that, I've heard that my house price has dropped 15-20%. So confidence amongst consumers is a worry, but I think it will improve next year. Another key measure here linked to the housing market is people spending on household furnishings, right? We saw quite a surge in spending as we came out of COVID. People assigned a much greater value to their house. They came out of COVID having been in lockdown for so long, and they thought, well, geez, I need a pool. I need to fix that deck, and I also need a home office. I'm spending more time at home, so I'm going to spend more money on my home. That has started to come off a bit. We've seen, spending around the home coming off a bit. Now, another thing which is quite important here is the surge in migration. We've had a massive increase in net migration, 120,000 people in just the last year. That's a record for us. So we've actually, nearly 200,000 migrants have come in. We've lost about 40,000 Kiwis leaving for offshore, and we've lost a few, migrants who are here already. But that net number of 120 is massive. And when you think about it, the first thing you need to think of was, well, where are they going? Most of them, turn up in Auckland and then head into the regions. But what do they need? What's the first thing you need when you go into a new country? You need a roof over your head, right? So that's putting pressure on rents already, and it will put upward pressure on house prices. This migration boom is massive. 120,000 in the last year. You need at least 50,000 homes for these people. We're not building that anywhere near enough to accommodate the surge in migration. So the housing shortage is getting worse. That's not good, but it does put upward pressure on house prices for the wrong reasons. And it's important to note that we've had quite a few experiences of massive migration booms. We had one at the turn of the century. It put big upward pressure on house prices into sort of 2003 and beyond. Then we had the largest migration boom in New Zealand's history between 2013, 2019. That put upward pressure on house prices. That the housing shortage was very severe. There was about a shortage of 100,000 homes over that period, which is massive for a small country. And now we've got yet another migration boom taking place and putting pressure on the housing market. Why do we let this happen? It's a stain on our economy. The fact that we just are unable to increase the infrastructure spending that's needed to increase the supply of housing in our country. So we're going to continue to see these shortages develop as we see these spikes in migration. So the fall in house prices that we've seen on the back of rapid interest rate rises is reversing, and it's reversing in large part because we've seen a surge in people coming in. The other chart there I like to show when I'm heading around the regions, that tourist numbers are bouncing back quite quickly. So are student numbers. That just puts more demand into our economy, particularly around the regions and the likes of Queenstown and Rotorua and other areas. That's a good news story. It really is a good news story. We're back to sort of 75% of where we were pre-COVID. We'll be back to 100% once the Chinese return. We haven't seen a return in the Chinese tourists yet because slow growth in China, but they will come back and we will be back to 100%, which is key for many regions. Now, what you all want to talk about is the housing market, and our view is quite strong. We believe we've been through the correction now. There was obviously that period coming out of COVID where we saw, amazing gains in house prices. 47% gain in house prices in 18 months. That's incredible. It's remarkable, and it's sad as well because a lot of that gain was on the back of housing shortages, which you don't want to see. And here we are having a central bank which has been very aggressive in tightening by lifting interest rates, but also playing around with loan to value ratios, mucking around with the triple CFA, which is a swear word in banking, and then other issues around bright line and removing interest deductibility, that sort of stuff, all contributed to a housing market coming off. Let's fast forward to next year. We've talked about the migration boom. Hopefully interest rates are starting to fall later next year. Hopefully the new government comes in and looks to water down the triple CFA, so enable a bit more credit to flow in the market. Maybe reduce the bright line from 10 to 2, which would satisfy investors, and also bringing back that interest deductibility. All of that is positive for the housing market. All of that is positive for the investor. What I'd say is that we tend to focus on demand. Demand's not the problem, but governments and central banks, they like to focus on investors. Investors are seen as the evil ones at times. Completely wrong. We should not be trying to reduce investor appetite. That's precisely the wrong thing. We need to be, I think, encouraging investors, particularly into new builds. So I am, hopeful that this incoming government knows that. Well, they do, and they're likely to take some of the shackles off the investor. We need to see more investors active. We need to see more supply of homes coming to market. That's the key. Anyone that talks about the New Zealand housing market will always talk about how unaffordable it is. They'll always talk about different aspects of it. The problem is supply, it's not demand. We need to do more on the supply side. What we are seeing, and I'm sure you're seeing as well, is a turnaround in activity, which is great. We're seeing activity in the housing market picking up. We as a bank, we're lending quite a lot actually. Kiwi Bank is really doing quite well. We're lending a lot, which is great. We've seen activity pick up into the warmer months, and we expect that to continue over summer. And that pickup in activity we're clearing a lot more stock now. We're seeing, sales being made. It's both sale prices maybe coming down a little bit, but the demand, the bid, the amount people are willing to spend is coming up and meeting supplies, meeting demand a lot more. So we're seeing more activity, which is really encouraging in the market, and that means that those house price falls we've seen are starting to become gains, and we'll see house prices rising next year. So our forecast for house prices, have obviously been through the correction. We think we'll see sort of 6, maybe 7% gain next year, and then some modest gains thereafter, but gains nonetheless. One thing to note is Auckland leads the way. So quite often movements in Auckland's house prices are then followed by the regions, and we've seen the Auckland market turning first again, and we've seen more gains in Auckland, which has been quite encouraging. There are obviously some regions here and there that are ahead or behind, but generally speaking, the Auckland housing market really does kind of define the cycle. It's our largest city. The encouraging data point that we like to look at is days to sell. I think everything comes through in that data. If it takes 30 days to sell a property, that's hot. The housing market's in a strong uptrend. If it takes 50 days to sell a property, that's cold. It's taking too long. So what we're seeing is the days to sell is declining and has declined for a few months now. So that to us is a strong signal that house prices are on the rise. And if those days to sell continue to creep lower, then that points to more confidence in the market, obviously getting things done quicker, and house prices rising. And that's pretty much the same chart as what I've already shown you. I've just shown you the same thing twice. There you go. And here we go with what we've seen in some of the regions. So one point I want to raise here is the yellow line, which is Christchurch. We haven't seen the same amount of decline in house prices in Christchurch, and the reason I highlight this is because Christchurch has obviously been through this massive rebuild after their earthquake. They're better supplied. The housing market is in better balance in Christchurch than it is in other areas, and it sort of proves that point that I made, that supply is our problem, not demand. When you do see an uptick in supply to better balance a market, you don't get the same volatility in house prices up or down. I think it's sort of proof in the pudding, so to speak, that you build more, you don't get the same fluctuations. You get a much better balance, much healthier housing market. Whereas you see, Auckland and Wellington, we've declined the most there and are bouncing back, as you would expect at this point. My last bit is around the LVRs. I think the central bank is more comfortable with house prices at the moment. They've said that house prices are more sustainable. That's their way of saying they're not as heated or moving away from where the fundamentals suggest they should be. So I think they will relax the LVRs again next year. They will also introduce DTIs, so kind of giving with one hand, taking with the other. But I do think credit will free up into next year, and we'll see, I think, a bit more activity and the availability of credit, mortgages, improving into next year. So I wanted to leave heaps of time for Q&A. I'm really keen on where you want to go with the discussion. If you have a question, please fire away, and I'll do the best I can to answer.
Cool. So, Jarrod, it seems like a really key factor that you have been hammering in is that supply is the issue, right? So, what advice would you have for investors that are wanting to increase supply, given that we've got immigration coming in? What kind of houses do you think people will be looking for?
Yeah, excellent question. So I think, if you look at the migrants that we're getting, they're mostly from Asia. So I think China and India are the top two, and then we get people from the Philippines as well. It's been a big surge in recent years. A lot of South Africans, but then a lot of people from other parts of Asia as well. They're coming from higher density countries. So, coming here and moving into an apartment, the apartment they're moving into, we might think is really small, but actually it's potentially quite large for them. And they have that higher density sort of mindset. So I think, anything from apartments to townhouses are going to be better suited. And, we need to, I guess, intensify. We need to, I guess, build more in smaller areas. And someone who's lived overseas, I've lived in Sydney, which is very similar to Auckland, but I've also lived in Singapore, and the thoughts of a quarter-acre block in Singapore are simply those that are of the mega rich. I lived in an apartment over there, and I thought, geez, I'd never enjoy living in an apartment, but actually I really did. You got a pool, you got a gym, you got all that sort of stuff, so it can actually be quite cool living. So I think we'll be heading more towards that. We'll be building much higher density dwellings, and that's what we need. But yes, the key point is increase supply, increase supply, increase supply.
Yep. And just thinking of these investors, quite a lot of them will try and increase the quantity of rooms in a house to try and maximize the rental yield. But how does that work with increasing unemployment rate, and what do you think is happening with the businesses in the property sector?
Yeah, so we are seeing a lift in the unemployment rate, which does worry us a little bit, but it's coming off a very low level. We've got a very tight labour market at the moment, and we're thinking the unemployment rate lifts from around 3.2, which was the low, to about 5.5 next year. So that is a softening. That is, more people out of work, but it's not the sorts of levels that drive mass defaults. Sort of move more towards a normal level of unemployment. It's when you see unemployment spike, through 7% up towards 8, 9, 10. That's when we start seeing a lot more defaults and a lot more weakness in the housing market. I think what we're seeing is just a bit of a softening after a very tight couple of years. COVID taught us something. We had this migration boom, which kept downward pressure on wages. We then went into COVID, which put upward pressure on wages, as there were no migrants, and now we're seeing the migrants coming through again, which is loosening up the market. Sorry, what was the other part of the question? It was the size of...
There's been some good questions come through in the chat just off the back of this around this is from Yvonne, investors may not return in droves unless interest tax deductibility is officially restored. So that doesn't seem to be in the new government's 100-day plan.
No, but we certainly hope it is something that they deliver. They have, I guess, promised that they would reintroduce interest deductibility. I think that's something that they will deliver on, and like that person mentioned, that's a key thing for investors. Investors have been hit really hard in the last couple of years, so the amount of lending that we're doing to investors is actually less than what we're doing to first home buyers. That's unusual. Normally investors are a lot more active than first home buyers. You know, the vast majority of our lending goes to existing owner occupiers who are, you know, selling one house, buying another.
Yeah.
That's the bulk of our lending. But then when you look at the first home buyers versus investors, I would love to see the investors spiking back to where they were. And if that takes, you know, interest deductibility, then we better put it back on.
And following on from that, what is your view on built to rent programs and who should be funding these?
Yeah, again, I am all for anything that is going to increase supply, and there's you know, a variety of ways in which we can do this, and these sort of built to rent ideas are a good one. They seem to work overseas. I think the government has a hand that it can play here to encourage and to help with you know, backstopping or providing cheap credit. I think banks have a role to play, obviously, as well, in providing credit at you know, reasonable rates. You know, my short answer is anything that helps increase supply is desperately needed.
Thank you. And do you see the possibility of banks offering longer than 5-year mortgages here in New Zealand?
There's just not demand for it. Funnily enough, we hear this a lot. We hear these questions, but then less than 1% of our mortgages go on 5-year rates. Less than 1%. Well less than 1%. So there's no demand out there anyway. And it's, if you look at, I think I had a chart of it before actually. There are only nerds like myself and maybe a few investors here and there that go beyond 3 years. So, you know, I personally fixed quite a bit of my mortgage for 5 years, most of it for 3 years. So it's all coming off next year, which is going to hurt me. But, you know, I'm an outlier, massive outlier. If you look at this chart on the right there, about 10% of people are on floating. They're probably in the process of running down a loan or you know, drawing down on a loan. It's only 10% floating. You know, 50% of people fix for less than a year. In fact, we're seeing a lot of people fixing for just 6 months at the moment. So that's the bulk is for a year or less, and then you get about 25% of people who like fixing for 2 to 3 years. You get an even smaller slither of people wanting to fix for 3 years, and then you're talking very, very small numbers who go 4-year and beyond. So yeah, there just doesn't seem to be the demand from customers to go out that far, let alone beyond 5 years.
Oh, I wish I was that 1% that fixed for 10 years.
Yeah, it goes, but hey, it goes both ways. Like I fixed in 2018 for 5 years, and that was a mistake because, you know, rates kept going down. Now I fixed for 5 years in 2021, and that looks great. But you know, it's over the cycle you get bitten as well.
Yeah, well, that was jam-packed with information. I'm conscious that we're at time, but this has been awesome. Jarrod, would you be open to sharing these slides that you've shown us today?
Yes, of course.
Oh, cool. Great. Well, thank you everyone for joining the Relab webinar, and thank you so much, Jarrod, for coming on. It's been great, and I hope everyone has a really good Christmas.
Excellent. Cool. Thank you.
See ya.